Okay, welcome and thanks everyone for joining the team representing BDH Sterling and BDH Tax today as we present to you a great session outlining an expat's guide to retiring in Australia, tackling the financial pain points. During the session, we'll share information and considerations for British expats considering retiring and with assets in both the UK and Australia jurisdictions. We'll cover some of the tax compliance and planning issues faced by expats, capital gains tax implications on UK property and assets, as well as foreign ownership rules for retained property in the UK. We'll also cover off estate planning considerations across the jurisdictions, and further, we'll provide information around pension transfers and the benefits of transferring those to Australia, as well as some of the investment and advice considerations you should know. Now today, the information that we provide is general information in nature. It's based on UK and Australian legislation as at the 25th of February 2025. It's general information only. It's not tailored advice to your specific situation. So before acting on any of the information contained in today's session, we'd encourage you to seek tailored and personalised financial advice. So my name is Brenton Ritchie. I'm the Financial Planning Manager for the Australian division of our business. I'll be helping facilitate today's session and assist with the Q&A at the end. Joining me today is Alan Collette, Managing Director of BDH Tax, who will take us through the tax, capital gains, domicile and estate planning aspects. Following Alan is BDH Sterling Senior Financial Planner Nick Bond. Nick will share his knowledge and experience across both the UK and Australian jurisdictions around planning for retirement and pension transfer strategies. So we've broken today's session into 6 key areas. Those areas start with expat tax compliance and planning issues. Tax residency status will be covered, visas and planning in advance. Estate planning considerations includes the importance of getting assets to the right people at the right time with the right tax consequences. Retirement income planning with Nick, the importance of modelling your sources of income against your future needs and planning ahead to meet your goals, needs and objectives. Pension transfers, starting with what is a QROPS, Qualified Recognised Overseas Pension Scheme, types of pensions and abilities to transfer, and what it takes to transfer and why advice is so important. We'll talk a little bit about BDH Sterling and BDH Tax, where and how we can assist, and then we'll have a Q&A session. So please feel free to type your questions into the Q&A section, and we'll try and answer as many of those as possible when we get to that section. If we don't get through all the questions, we'll look to come back with any specific answers to questions or queries you might have post the webinar. So let's get started. We'll move across to Alan now, who will take us through expat tax compliance and planning issues. Alan.
That's great. Thank you, Brenton. So, bear with me. Tax residency status. Tax residency is key to where income is taxed and how it's taxed. The UK has a statutory residency test which underpins the basis upon which one considers one's tax residency status. There are a number of tests that we work through to ascertain whether or not you're a resident of the UK. Australia operates more qualitative tests. There's a resides test, there's a domicile test, there's a 183-day test, and a less frequently encountered superannuation test for those who are members of Australian government superannuation schemes. Because residency is a jurisdictionally specific subject, it is possible to be tax resident in the UK and in Australia under their domestic provisions at the same time. Now, in that circumstance, we need to look at the tax treaty that exists between the UK and Australia. Specifically, Article 4 of the treaty discusses residency. It's known as the residency tiebreaker tests. And we work through each of those tests in turn to determine where you're resident for treaty purposes. So just to recap, we have residency tests in the UK, the statutory residency test. We have a residency test in Australia. You can be resident in both. And if that is the case, we look to Article 4 of the treaty to determine where you are treaty resident. Now, you might be in a different country other than the UK or Australia. tax treaties don't exist between all countries. And in that circumstance, you have to deal with the local authorities and their own rules. I want to specifically look at pension income because I know it's an issue that will affect quite a few of you. Pension income is dealt with at Article 17 of the tax treaty between the UK and Australia. And if you are treaty resident in Australia, Article 17 provides that the pension income is solely taxable in Australia. So if you're in receipt of, say, an occupational pension from the UK, the default position is that that pension will be taxed and administered under the UK pay-as-you-earn system. And it's quite possible that some tax will be withheld under pay-as-you-earn from the UK source pension. But under Article 17, as I say, that pension income is in fact solely taxable in Australia. And so there's a process that one needs to go through. If you're residing in Australia, you have a tax file number there. There is inevitably a form to complete. That form is sent to the tax office. One requests a certificate of residency in Australia, and once that has been processed, it is sent to HMRC in the UK, and that should lead to the issuing of an NT, no tax, PAYE coding, and the pension income is then paid to you on a gross basis and is then dealt with solely in Australia. You pay your tax in Australia, the pension income is included on Australian tax return, and you, as I say, pay your tax to the Australian Taxation Office. Any tax that has been deducted under PAYE already, if you've been living in Australia for 6 months, 12 months, and you've had tax deducted under pay-as-you-earn, the process of preparing the tax treaty form and getting the certificate of tax residency should lead to the repayment of tax from HMRC under the provisions of Article 17. Now, Article 17 pertains where you are a permanent resident or a citizen of Australia. So let's just go to the next slide, which talks about people who are temporary tax residents. Forgive me, slides just slightly out of order here. I can't immediately find that slide. So I'll just quickly talk about temporary tax residents. Individuals who are residing in Australia and who hold certain types of temporary visa. So here we're talking about people who are in Australia on subclass 870 sponsored parent temporary visas, people who are living in Australia on sub 482 employer sponsored visas, working holiday makers, people who are on bridging visas, awaiting decisions on other substantive visa applications. They are temporary residents, and Australia provides that people who are residing in Australia on those types of visas are usually exempt from tax in Australia on their foreign source income and capital gains generally. So in that circumstance, if you're living in Australia on a temporary visa and you're in receipt of, say, pension income from the UK, that pension income remains taxable in the UK and is not taxed in Australia because of your visa status. In the event that you acquire permanent residency, then the pension income is then dealt with under the provisions of Article 17, such that it's then solely taxable in Australia. So your visa status can have an impact on how pension income is taxed. Turning to rental income from property. Income from a rental property is taxable frequently in both countries. The tax treaty doesn't give sole taxing rights to either country in respect of rental income. Rental income is typically taxed initially in the country in which the property is located at first instance, and then the rental income is taxed in the country in which you are a tax resident. So if you've got a property in the UK, and it's initially taxed in the UK, you submit a self-assessment return to HMRC. If there's any tax payable in the UK, then that tax is then creditable against your liability in Australia in respect of that rental income. It's known as a foreign income tax offset. So rental income typically taxed in both countries unless you're a temporary visa holder and can make use of those temporary tax exemptions that I mentioned previously. It's important also to note that the way you calculate the rental profit is different between the UK and Australia. Moving to the next slide. So the rules in Australia for calculating tax deductions are more generous than in the UK. In Australia, you are allowed to deduct depreciation deductions. You're allowed to write off the cost of the construction of the property if it was built in more recent years. Over 40 years, that amount can be claimed as a tax deduction in Australia. These deductions are generally not available in the UK. Also in the UK, there are restrictions as to the amounts that you can claim in respect of finance costs, typically mortgage interest. In recent years, the UK government, HMRC, has limited the deduction that's available in respect of finance costs, mortgage interest, to a tax credit at the basic rate only. So if you're residing in the UK, let's say, and you have a rental property in Australia, and you're financing the rental property in Australia, it's quite possibly that property could be negatively geared, as it's called in Australia. You're sustaining a loss for tax purposes in Australia. But in the UK, the rules are different. So it can be that you end up with a tax liability in the UK because the deductions are more limited in the UK when you report that rental income to HMRC on a UK tax return. Here's the slide on temporary visas. So if you're moving to Australia on a temporary visa, subclass is 188, the Business Innovation Scheme. Subclass 417, the Working Holiday Maker Visa. Subclass 482, Employer-Sponsored Temporary Visas. 494, a Skilled Regional Visa. And 870, Sponsored Parent Temporary and Bridging Visas for those who've applied onshore for visas such as subclass 804 and 864, the onshore parent visas. These are temporary visas, and these facilitate the exemption from the charge to tax in Australia in respect of foreign income and capital gains that I mentioned earlier. It's important also to note that if you have one of these visas, but you have a partner or spouse who's an Australian citizen or permanent resident, then these exemptions aren't available. So some key points that we encounter, remote working. So increasingly these days we see people who are living in Australia continuing to work for a UK employer or vice versa. This introduces a measure of complexity that frequently people don't consider. People want to continue working for an employer in the UK, for example, if they move to Australia. There are consequences which ought to be considered. There can be payroll obligations for the employer based overseas. There may be personal tax filings in your previous country of residence that need to be considered. The question of your residency status again needs to be borne in mind. And there's quite possibly a continuing obligation to file tax returns for the previous country in which you were residing. So advice early is key. It's important to be engaging with your tax advisor before you embark upon a move. You can't plan after you've moved to the new country. If you find yourself in a less favourable tax regime, we can't wind the clock back and say, oh, we can't treat you as if you were still residing in the old country. And this can be a factor where, for example, you want to sell a property. You might own a property. You're living, say, in the UK. You've got investment properties. You might want to move to Australia. Should you sell the investment properties now, or should you sell the investment properties once you've moved to Australia and cease to be a tax resident of the UK? If you've owned investment properties for a number of years, there is a valuable opportunity to rebase the value of the property for capital gains purposes in the UK to its value in April 2015. So we've had cases where people have owned investment properties, own them maybe 20 years or longer. If they sell those properties while they're residing in the UK, then the capital gains tax calculation is going to have reference to the original cost of that property. But if you sell it once you've moved to another country and cease to be resident in the UK, that opportunity to rebase or uplift the value of that property for the capital gains calculation to its value in April 15 can be incredibly valuable and wash out a substantial amount of the capital gain from the charge to tax. If we interface this with the temporary tax resident exemptions in Australia, if you're moving to Australia on a temporary visa, the capital gain in that circumstance isn't taxable in Australia at all. And so we can get some very attractive tax outcomes if you're moving to Australia, and you can defer the disposal of the property until after you've moved and cease to be a resident of the UK. So timing is key, and comparing the tax situation if you're in the UK and are selling a property now compared with moving overseas and selling it as a non-resident can be some very attractive tax outcomes if you time the disposal judiciously. The flip side, if you own a property in Australia and move to the UK, if you've got a residential property that was your main residence in Australia, since the 1st of July 2020, you're no longer allowed to treat a period of occupation of a main residence as being CGT exempt. And so selling an Australian property, having a former main residence, having left Australia, can lead to some very unwelcome tax outcomes. So again, take the advice early before you leave Australia if you're planning to head overseas. Another area where we're often asked to provide input is where you have a limited company. The limited company might have retained profits in that within it, profits that might have not been distributed and accrued within the company over a number of years. And the question that often arises is, well, how do I get that money out of the company tax efficiently? Well, one of the things you don't want to do is to wait until you're in Australia to extract the monies from the company, because the valuable exemptions that can exist in the UK, capital gains tax relief in the UK that can reduce the tax on distributed funds to 10%. If you distribute those funds as a resident of Australia, they're going to be taxed at your highest marginal rate. So again, planning, timing, taking advice early if you've got a limited company and are changing jurisdictions. Moving on to estate planning. So a quick recap on who is involved in the process of dealing with wills and estates. Who's involved with the will in the event of a person's passing? We've obviously got the deceased person, we have executors, and we have beneficiaries. These are generally the core persons who are referenced within the will of a deceased person. The executors have the responsibility for administering the deceased's estate. It includes dealing with any outstanding submissions to the tax authorities. The deceased person may have been filing tax returns under self-assessment in respect of income. There'll likely be an outstanding tax return that needs to be submitted. That's the responsibility of the executors. And any income or gains that arise during the period of the administration of the estate are also most commonly reportable to HMRC in the UK. The beneficiaries receive the estate of the deceased, and they do so in accordance with the wishes of the deceased as expressed in the will. It is possible to execute a deed of variation to vary wills. That's not dealt with here. But in the event that all the beneficiaries agree, it is possible to vary the provisions of a will to achieve a preferred outcome. The taxes that are payable on one's death in the UK is inheritance tax. In Australia, we don't have death taxes in Australia. But bequeathing certain assets, such as shares to a non-Australian resident beneficiary, can trigger a capital gains tax liability for the estate. The UK charges inheritance tax on the estate of the deceased, and at the moment, the scope of UK inheritance tax is a function of what's called your domicile. Domicile is a different attribute to residency. But as some may know, we're changing. The UK government is introducing a residency-based approach to inheritance tax from the 6th of April coming up. UK-based estate is always within the scope of the charge to UK inheritance tax, whether you're domiciled in the UK or not a long-term resident from the 6th of April. UK-based estate is always within the scope of UK inheritance tax. So if one can establish a position where only UK-based estate is subject to UK inheritance tax, strategy then will often involve realising one's UK-based estate, taking that outside the UK, investing it elsewhere in the world, because that makes it non-UK-based estate and therefore outside the scope of UK inheritance tax. So domicile presently, long-term residency from the 6th of April is key to the scope of the charge of UK inheritance tax. So looking at the new provisions coming in on the 6th of April will be based upon long-term residency status, and an individual will be considered to be a long-term resident of the UK and hence subject to UK inheritance tax on their worldwide estate if they've been resident in the UK for at least 10 out of the last 20 UK tax years. What that means for people who are presently living in the UK is that they will remain within the scope of UK inheritance tax as a rule. If they've been residing in the UK for many years, they'll need to be non-UK resident for at least 10 years before their worldwide estate escapes the charge to UK inheritance tax. A tax year in which a split year applies. So if you leave the UK to live in Australia on the 1st of August this year, 1st of August 2025, you'll be resident up to the time of leaving, non-resident from the time forward, most probably. That year is counted as a year of residence. So just to recap, you've got to be non-UK resident for 10 years going forwards if you are going to escape the charge to UK inheritance tax on your worldwide estate. So this 10-year tail, as it's called, pertains where one has been resident in the UK for 20 years or more. So if you're emigrating to live in Australia and you've lived in the UK for your life up to now, you're looking at a 10-year tail. Where you've only been resident in the UK for between 10 to 19 years, there's a sliding scale that determines the number of years in which a number of years absence before you can qualify as a non-long-term resident. So there is a transitional rule. The UK Chancellor introduced a transitional rule in her budget at the end of October. So if you're not domiciled in the UK and not resident in the UK for tax year 25-26, the forthcoming tax year, you will not be considered to be a long-term resident if you satisfy the present deemed domicile rules. So forgive me, there are lots of rules here, lots of technicalities. You are deemed domiciled in the UK at the moment if you've been resident in the UK for at least 15 out of the last 20 years. We need to review residency status for a number of years and future plans if we're going to plan to mitigate UK inheritance tax. As I say here, the rules are complicated. So a few exemptions from UK inheritance tax, irrespective of your domicile and long-term residency status. Assets that pass to a surviving spouse, exempt from inheritance tax, so long as the surviving spouse is domiciled in the UK. In that circumstance, the UK's nil rate band, the amount you can bequeath to other persons before you pay any inheritance tax, if all of your estate passes to a surviving spouse, the IHT nil rate band is not used upon the first death, and so it is capable of being transferred and applied upon the death of the second spouse. So in that circumstance, if first spouse dies this year and all of the estate passes to the surviving spouse, and the surviving spouse dies 2 or 3 years from now, when that second spouse's estate passes to beneficiaries, the available nil rate band is twice £325,000. There's £650,000 of estate can be bequeathed upon second death before there's any UK inheritance tax liability. Now, where the estate includes a main residence, a former main residence, where that property is bequeathed to a linear descendant, a child or a grandchild, there is a further exemption available for inheritance tax. It's known as the residence nil rate band. It's £175,000 per individual. Again, if the property ownership upon first death passes to the second spouse, the unused £175,000 is available to be used by the estate upon the death of the second spouse, where a property is passing to children and grandchildren. So the 325 plus the 175 times 2 gives £1 million of exemption that's potentially available from the charge to UK inheritance tax. Other valuable inheritance tax exemptions, gifting. It's possible to gift assets. They're known as potentially exempt transfers, or pets. They're free of inheritance tax if the person making the gift, the donor, survives for more than 7 years. Where the donor passes within 7 years, then some of that gifted amount will fall within the charge to UK inheritance tax. There's a tapering that comes in after 3 years. If the donor dies within 3 years, the whole of the gift is within the charge to UK inheritance tax. 3 to 4 years, 80%, and it slides away 60%, 40%, eventually reaching nil after 7 years. Regular gifts from surplus income are IHT free. So if if you're receiving an income and the income is surplus to your day-to-day living requirements, it's possible to bequeath monies regularly out of that surplus income, and there's an exemption there that enables those gifts to be made on a free of IHT basis. They won't be considered or added back into your estate when the time comes for your estate to be administered by your executors. The PET provisions, I'll just mention here that the PET, potentially exempt transfer provisions, may be relevant when one is gifting funds to a relative in Australia, for example, to acquire property. Now, it's beyond the scope of today's webinar to talk about the changes that are coming in Australia, whereby temporary residents can't buy property in Australia from the 1st of April. At the moment, there are likely to be additional stamp duties payable if you're buying a property in Australia as a temporary visa holder. There are Foreign Investment Review Board charges if you buy property in Australia as a temporary resident. A lot of people look at gifting money to children who are residing in Australia to facilitate the purchase and to mitigate the impact of some of these charges. Gifting of monies to children in that circumstance, you could reasonably plan, I think, on the basis that the potentially exempt transfer provisions would be available in respect of such a gift. There are other issues, I hasten to add, that need to be borne in mind if you're gifting money to a child to buy a property in which you're going to live. And as I say, that's beyond the scope of today's presentation. So wills are jurisdiction specific. A will prepared in England and Wales won't automatically have validity in Australia and vice versa. In the circumstance where you have a UK will and you have assets, you move to Australia and you acquire assets in Australia, there's likely to be a need for the executors to go through a process of what's called resealing the will in order to be given the authority to deal with the Australian-based estate. Because of this, because of the additional cost and time that is likely to eventuate if you have assets in Australia and only have a UK will, it's often best to have a UK will that deals with your UK estate and an Australian will that deals with your Australian estate. Make sure they're not in conflict with each other so that the wills aren't invalidated. That would facilitate the more efficient administration of one's estate upon your passing. Talking to a solicitor who's across these issues, very important. And we perhaps inevitably have an associate. If you need to talk to someone more fully about wills drafting, let us know and we can provide you with powers of attorney, often considered at the same time as wills, ought to be considered at the same time as wills. They are also specific to a jurisdiction. So an enduring power of attorney that you might have taken out in the UK to deal with your finances and your medical affairs in the event of your incapacity, that those powers of attorney will generally not have application in Australia. You should prepare a power of attorney locally in the state in which you're residing. Generally, a power of attorney that's prepared in one state will be recognised in another state, but powers of attorney are technically state specific. And so if you move from Western Australia to Victoria, let's say, it would be prudent to have a new power of attorney. If you have had a power of attorney prepared in WA, it'll be prudent to have a power of attorney prepared in Victoria once you've moved there. So yes, preparation of wills and powers of attorney generally best done at the same time with the same solicitor. And that's it from me for now. Thank you for listening. I'll be back for the Q&As and I'm going to pass over to my colleague, Nick Bond.
Thanks, Alan. That was really informative, and thanks for your time. So welcome everybody, and thanks for joining us. I'm going to cover off retirement income planning and pension transfers. When formulating a financial plan, or specifically a retirement plan, it's very important to understand what your objectives are. So when and where do you want to retire? So would you like to retire in the UK? Would you like to retire in Australia? Would you like to retire elsewhere? At what age would you ideally like to retire? And very importantly, how long do you think, how long will your money need to last? Obviously, that's a very difficult question to answer. So it's better to overestimate than underestimate. But these are crucial things to start considering when looking to determine affordability of retirement and what age you can afford to retire. Okay, so that builds into cash flow planning. So if you're in the accumulation phase, pre-retirement, and even in post retirement stage, cash flow planning is crucial. So we can help with this. We'll look at your income and your expenditure, look at where your money's going and what it's being spent on. Is there any known future commitments, for example, university fees for 3 or 4 years for your children? Was there any big planned expenditures in the future, weddings and helping children with purchasing property potentially? And then we can look at what are the most important priorities for you. So where does that money need to be diverted to in order to be able to meet these future liabilities? So this is a very key part in mapping out what that plan looks like. So the cash flow forecasting, what we can do when we've understand your situation, the retirement age, income required in retirement, future expenditure and large capital expenses, we can then produce a forecast, a model of what it's going to look like for you in the future. We can produce a model of what it looks like if you do nothing and continue on as you are, and we can produce a forecast of here are recommendations and this is the impact that it has. In the top model there, you can see that there's a bit of a shortfall of retirement income, but we can then, with some tweaks and some guidance and some help, hopefully get you to look like the second model where your income needs will be met beyond life expectancy. We'll also factor in inflation because that will have a key impact on how long your money's going to last, and ultimately come up with a strategy to help you meet those important objectives that you outline when we first get into the financial planning journey. So touching on pension contributions, as Alan mentioned about the taxation of pensions, the UK and Australia have different rules of how pension income is taxed. So for example, in the UK, when you're paying into the UK pension, the UK government provide tax relief on the way in. It grows tax-free in the UK, but on the way out, there is tax deducted from income you draw, apart from an allowance for a lump sum of commencement of a pension. In Australia, it works the other way around. So when you're paying in, you get tax deducted on concessional contributions, and on the way out, when you're in pension phase, there is no tax to pay on pension income. But if you're living in Australia and you've got a UK pension, as Alan mentioned, there's tax complications, and vice versa. If you're living in the UK and you've got Australian superannuation and you want to draw from it, there will be can be tax implications there. So overarching, what we want to do is try and get the most tax efficient strategy for you, whether you're living in the UK and moving to Australia, and going to retire there, or whether you're living in Australia and going to retire in the UK, we need to map out a tax efficient strategy to access the super fund or UK pensions. So yes, retirement income won't all necessarily come from super or pension. You might have rental properties that will generate income. You might have investments outside of super or pensions, which may generate income, capital gains. And depending on the age that you want to retire, for example, some of you may have aspirations of retiring at 50, and if that's the case, you can't access a pension in the UK until you're 55, you can't access superannuation until you're 60. So there needs to be a way of bridging that gap and providing you income from other sources of investment that you might have. So that is all factored in when we're looking at that income forecasting and looking at the cash flow forecasting and where to direct your money now while you're in accumulation to make sure that you can meet your objective of retiring as you'd like to. And yes, the different different tax outcomes, whether that be pension or super or investment properties, as Alan said, there's different tax treatments for different assets that you have. So we need to be mindful of that when we're working through the projections as well. Okay, the other thing that will be an income stream for some of you will be the state pension and potentially the age pension in Australia. So the UK state pension, you will have an entitlement to that if you worked in the UK for 10 years or longer and made national insurance contributions, or your employer has on your behalf if you weren't self-employed. It's a good idea to check what entitlement you have. You can do that online via gov.uk to see how many qualifying years that you've got. It's not to be underestimated, and sometimes some people overlook, but getting an understanding of that is crucial, because there is an opportunity to potentially top that up if you're short of the maximum 35 years. So that can provide a really good base income for you in retirement. With the age pension, it's not a contributory pension like the national insurance contributions. It is based on assets and income test. So some people may be able to achieve that at 67. Some people may never get it, and some people may get it as they get a bit older and their assets or income starts to dwindle. But that does play a key role in understanding and forecasting your retirement income. Okay, on to the pension transfer slides. So we start off with the QROPS, ROPS, it's actually officially known now, Qualifying Recognised Overseas Pension Scheme. These were introduced in 2006 as a way to allow individuals to more freely transfer their UK pensions to other jurisdictions. The QROPS must meet certain requirements that are set in place by HMRC, and Australia has different requirements from other jurisdictions. So potentially, you might be able to transfer to a different country at a different age, but Australia, for example, has a set age limit that it can meet. A QROPS is a good option for those that have permanently left the UK and intend to retire abroad and having built up a UK pension fund. So what are the benefits? Your QROPS scheme, if you're living in Australia, will be based in Australia. You haven't got to deal with different jurisdictions, different time zones to speak to your pension provider. You can have your fund in GBP or AUD, depending on how you feel about the currency and your income requirements in retirement. For some people, they'll be spending a significant amount of time in the UK potentially and may want to keep some pounds. Your benefits, 100% of your pension can pass over to your dependents when you pass away, compared to in the UK, there's some tax that can be deducted depending on who you pass your pension to and what age you're passing. And also just touching on this, but not going into detail, UK pensions are looking to be brought into the remit of the IHT tests, which is something to be aware of. In tax treatment benefits, so in Australia, it generally is more favourable to be drawing down from a super fund than from your UK pension if you're living there. As I mentioned before, there you can access your super fund tax-free, whereas you will pay or income from a UK pension will be assessed in Australia, and vice versa. If you've got a super fund and you're living in the UK, that income will be assessed by HMRC. You might have multiple UK pensions, you might have multiple superannuation funds, so there can be an opportunity to consolidate all of these into one QROPS fund to make sure understand what benefits you've got more clearly. QROPS responsibilities. So there is a reporting requirement for a QROPS scheme to report for 10 years from the date of the transfer. The benefits that you receive from a QROPS scheme must be broadly in line with UK scheme rules. And there's also a member payment provision period that will be applicable upon the transfer to a QROPS as well, which these responsibilities have to be taken care of in order for that fund to remain a complying fund and for tax charges not to be applied down the line. Australian QROPS options. So there are only two options available. One is a self-managed super fund, and the other is a retail fund that anyone over the age of 55 can join. 55 is the current age. That is actually moving up to 57 in April 2027. So they're your only two QROPS options within Australia. So QROPS trustees are ones responsible for the reporting for 10 years from the date of transfer. They are the ones who are gatekeepers, making sure that your fund complies with all the QROPS rules and you don't breach any compliance requirements of the QROPS. So what types of pensions can be transferred? Defined benefit schemes, if you're lucky enough to have a defined benefit scheme, they can be transferred. A defined contribution scheme, so a SIP or a personal pension or a group personal pension, they can be transferred. Some UK funded public sector schemes can still be transferred, such as the local government pension scheme. Other QROPS that might be in other jurisdictions, they can also be transferred to an Australian QROPS scheme, and also a QNUPS, which are pretty rare, but QNUPS can be transferred also into a QROPS scheme. What cannot be transferred? So the UK state pension, that doesn't have a capital value, that will always be paid out as income. You can't swap that income from payout. It will always be paid as a pension income. Government unfunded pension schemes such as NHS, Army, Police, Fire Service, there are quite a few that are caught up in that. They cannot be transferred. That was stopped in 2015. Some defined benefit schemes, if they've run into trouble from a funding perspective, they may have fallen into pension protection fund. If they are inside the PPF, then they cannot be transferred. For any people that have taken out an annuity, so bought a lifetime income from an insurance company, those annuities, once in payment, cannot be transferred. So why transferring the UK pension may not be suitable. So with a defined benefit scheme, they are very good schemes. And the FCA, the Financial Conduct Authority, has a starting point that people should not transfer out of a defined benefit scheme. That's their starting point. We have we look at the entire situation of the individual living in Australia, whether that makes sense or not. But for those that are UK based, the FCA are saying that a DB transfer isn't suitable, or that's the starting point. It's not always cost or tax effective, so there are costs associated with the transfer. If you're using an advisor, there'll be advice costs. There'll be tax potentially to pay on the transfer fund. So depending on the size of the fund, depending on how long you've lived in Australia, if you're transferring across, then it may not be tax effective, and it might be better to actually leave the fund in the UK. Your UK scheme might be providing good returns, and those could be difficult to match. But look, that's going to all depend on what you're invested in and how it's invested as to those returns that are being provided. Some schemes in the UK can give you market value reductions or transfer out penalties if you transfer out before a set retirement age. And some people who've got DB schemes, you've got no risk with that defined benefit scheme. The income's underpinned by the UK government, and you'll have to take that lump sum that is paid out, and you'll have to invest that in the markets. And there's no certainty that will provide you with the same income or more that you get from the defined benefit scheme. There's going to be market risk for the duration of time that the funds are invested. So why should you consider transferring? One of the big ones is considerations is the exchange rate. As you can see from the graph, there are lots of fluctuations over the years. I was unfortunate enough to move over in when the exchange rate was £1 to $1.45 a while ago. So that I've experienced the worst of it. But as you can see, there are peaks along the way. There are times when it can be good to make that trade. Overarching, it's to give you some certainty of your retirement income. Back to the previous slides, you want to understand what your retirement income is. You don't want it fluctuating by 10 or 20%, ideally, based on an exchange rate that is completely out of your control. Estate planning, as I touched on earlier, there are implications for a UK pension. If you pass away over the age of 75 and you still have money in your UK pension fund, regardless of who you pass it to, there will be tax assessments once you pass away post age 75 on the beneficiary. Investment control. Look, this goes both ways. You can still have an investment control if you're in a defined contribution scheme, but you've got a lot of options to be able to invest in. If you're bringing your funds over, you can take an active interest in how much risk you're taking and what type of return you're hoping to achieve, and that again feeds into the forecasting and planning side of things. So you're able to help affect the outcome by having a little bit of investment control on how the money is invested. But as I say, you can do that in UK pension as well to large degrees. Okay, tax treatment benefits. So, yes, drawing out a pension from a superannuation fund is tax-free in Australia. If you're living in Australia, and not for those that are residing in the UK but drawing from a super. So moving over a UK pension, where you're going to be assessed for tax on the income, moving it to superannuation, where you're going to get it out tax-free, can be a very good outcome for people. Only the growth of the fund since you arrived in Australia to the date that you transfer, that is the only assessable part, taxable part of the UK pension fund. So for those that have lived here a long time, there's going to be a fair amount of growth. For those that are moving soon or have moved in recent years, the growth shouldn't be too substantial. So there can be a big benefit in accessing that tax-free if you're paying very little tax or transfer. And again, consolidating your pensions might save fees overall, give you a better understanding of what retirement provisions you've got and how they're invested. Okay, so tax on UK pensions. As I mentioned, the income from a UK pension scheme is assessable to tax, and Alan gave more detail on that earlier, so I won't touch on that too much. 25% can be drawn out tax-free from the UK end, but that is assessable in Australia. It's not tax-free completely. It'd be the growth of the fund from when you arrived in Australia to when you draw on that 25% lump sum. And lump sums outside of that 25% could potentially be taxable in both countries. So if you draw a big lump sum out of the UK, there could be tax to pay in the UK and there could be tax to pay in Australia as well. The tax on the transfer to Australia, it is the growth from the date of arrival to when the fund is received in the Australian super, and then the remaining balance in the UK, there is no tax on that, but it is subject to the non-concessional contribution tax limits. Sorry, non-concessional contribution limits, not tax limits, sorry. Transfer options for those under 55, you can't move it to Australia, but what you could do is consolidate in the UK into a self-invested personal pension, whereby you can buy and invest in Australian dollars, or you can simply leave it where it is until you get nearer to that age. But as I say, that is moving up to 57 in April 2027. What is a SIP? So it's a self-invested personal pension that have more options than a standard personal pension in the UK. For example, you can keep GBP or buy Aussie dollars. You can invest in GBP and Aussie dollars. You can put the 100% of the pension passes to your beneficiary if you pass away under 75. Some schemes don't offer that, but for example, defined benefit schemes will be a 50% spouse's pension, typically passing on upon the first death. And you can also have as much input or as little as you wish within a self-invested personal pension. So they can be useful vehicles for some people. So what is the transfer process? So contact us, get in touch, and we can book in a free meeting whereby we can talk through what I've touched on in greater detail to make sure that it's suitable for us to give you the advice. For some people, the easier option or the better option is leave it where it is. But regardless, we can discuss that and determine whether or not there is a need for the advice. Once we take you on board, we will provide you with a pension transfer analysis report, which will give you the information you need, plus a formal recommendation from us of what we think is in your best interest with regards to transferring or keeping those pensions. And if you want to, following that pension transfer report, we can then help you to implement that advice and get it out of the UK and over to Australia, or for those under 55, we can consolidate those pensions in the UK in the lead up to you hitting 55. So why should you seek advice before you make any decision? As Alan mentioned earlier, you can't undo something that's done. And unfortunately, we do come across people that have done what they believed or been advised was the right thing to do prior to speaking to us. But that can often cause prevent you from transferring or give you some difficult tax liabilities and decisions to make. If you do things incorrectly in the QROPS world, then there can be tax charges of up to 55% that can apply to non-compliant transfers. And also confirming if the UK pension is transferable in the first instance. So it's always good to seek advice before jumping in to make sure you get the optimum outcome. So I will now pass you back to Brenton.
Thanks, Nick, and we will take through a little bit about BDH Tax and BDH Sterling. So BDH Tax is a firm of registered tax agents with offices in Australia and the UK, specialising in delivery of tax solutions for individuals who are moving across those jurisdictions, especially moving to Australia. So BDH Tax can certainly help with issues raised in the presentation, and there's some details there of how to get hold of Alan and the team at BDH Tax. So either by phone or sending inquiries, emails to tax@bdhtax.com. BDH Sterling, obviously for Nick and myself here, operating within a chartered firm in the UK. BDH Sterling is one of the only chartered firm with representatives within Australia. We have dual licensed advisors in both jurisdictions, permission to provide pension transfer advice across the teams that we have here. Very much defined benefit scheme specialists. Certainly that's an area that we provide a lot of advice to clients in and specialise in. And we've been operating in this space, providing pension transfer advice for over 15 years now. So certainly long established in Australia and absolutely long and established in the UK in this space. Advice is provided in-house. There are a lot of providers within Australia who outsource the pension transfer advice. We absolutely do that in-house with our teams across both those jurisdictions. And again, as you've met with Alan today, certainly have avenues for advice on broader Australian superannuation, retirement planning, and other aspects of personal advice situations. Inquiries at bdhsterling.com will get you through to the team, and Nick will certainly be one of the first people that you talk to as you come through the door there. For sending emails through, be really great if you give a quick idea of what you're looking to achieve. A bit of a description of ages at the moment, obviously very pertinent from accessibility of pension for transfer and also from superannuation in Australia, and a bit of a broader advice or retirement plan of what you're thinking there. So we will jump into the Q&A. We certainly have a fair few in there, but first, thanks to Alan and Nick for taking us through the contents of the presentation. We'll go through the questions that are in there. There's quite a few already. Please feel free to keep typing your questions into the Q&A section. We will focus on the Q&A section first. I know there are some questions that have come through the webinar chat to hosts and panelists, but we'll focus on the Q&A, and if we don't get to the other ones, at least the webinar chat gives us the ability to come back to those specifically afterwards as well. So we might start off at the top of the list there. Alan, if we can throw this one to you first off, and maybe Nick, if you want to follow up, but how can you minimise tax in Australia if you draw a UK pension?
Tax in Australia if you draw a UK pension, if it's taxable, the pension is taxable in Australia, there's potentially an opportunity to claim a tax deduction for what's called the undeducted purchase price of the pension. So if you've made personal contributions into the fund from which you're deriving the pension, it is possible to claim an annual tax deduction of an amount equal to the amounts contributed by you personally, divided by your life expectancy. There's often people will seek what's called a private ruling from the tax office in order to quantify the amount of the tax deduction. But the main deduction, the main opportunity to reduce the tax on a UK pension is going to be through the use of an undeducted purchase price. In the alternative, if there's no UPP deduction available, the entirety of the pension is going to be taxable in Australia. Noting also that UK state pension, there is a UPP available of 8% of the amount of the UK state pension.
Perfect. Thanks, Alan. I'll keep you rolling on this one. As an Australian resident, where does the tax liability get paid for 75% of the private pension pot that in the UK is taxable?
I might ping that to Nick, actually, if I may, Brenton, if that's okay.
So if you're referring to taking taking the 25%, remaining 75%, if you're resident of Australia, then the tax is going to be payable in Australia under Australian marginal tax rate. So if you take it out as the remaining 75% as a lump sum, there's tax to pay on the growth from either when you arrived or when the last taxable event occurred. If you take it out as income, the remaining 75%, then that entire income is going to be assessable to tax in Australia. There may, as Alan said earlier in the presentation, there may be tax deducted at source in the UK, which you can claim back. But essentially, it's all going to be assessable in Australia.
Perfect. And good pass there, Alan, because I misread part of that question, the intent. I'll keep you going, Nick. Investment options for pensions transferred from the UK to Australia. Maybe a little bit around high-level philosophy and things that are available to clients from the Australian side of it.
Yeah, depending on route you go down with regard to the SMSF or the retail fund. The retail fund is, whilst there's a lot of option, it is more restrictive. An SMSF is what we would call open architecture, where you can simply invest in anything that's allowable under superannuation legislation. You might then be subject to what a platform offers or what a brokerage account offers, but it's very broad. It will be, if we're helping you, we will cater it to what your investment risk tolerance is, also factored in with your goals and objectives of what retirement income you need. But yes, broadly speaking, it will be invested in global markets. There'll be fixed interest exposure in bonds. That's all going to depend on how much risk you're prepared to take. If you're at the higher end of the threshold, a lot more will be invested in the global markets and Australia. There will be a good exposure to the Australian markets as well, not just the US and other big markets. And if you're at the lower end of the risk tolerance, there'll be more exposure to bonds, government bonds, fixed interest, term deposits, corporate bonds, etc.
Perfect. Thanks, Nick. There's a question here which is around ongoing costs and fees of a financial advisor for pensions that have been transferred. It's a broad question or broad answer to that question. It can be from $0. You could choose to self-manage, not necessarily self-manage super fund, but you could manage it yourself, either in a retail platform, SMSF, and therefore not pay an advice fee. That could then lead to paying a fee for time, fee for service. Typically in the industry now, it's probably around $400 per hour, what you're looking at from an advisor's time. A lot of advisor practices now have a minimum fee of from about $4,000 is probably the industry typical minimum ongoing fee for financial advisor, and percentage based as well from a, say, call it a 1% fee that could apply. The main bit is engage the advisor, talk to the advisor, build trust in the advisor, in the practice, and then talk about what that actually looks like, because there are different options that could apply depending on situations. But typically a practice will have a way of applying a methodology across clients. Alan, this one I think might be for you. Be moving to Australia for tax residency purposes, but my spouse will remain a UK resident in the short term. Will this affect me?
In an income tax sense, no. You are treated separately, such that if you are the Australian resident, you'll have your Australian tax obligations locally. If your partner, spouse has remained in the UK, then he or she hasn't become a resident of Australia, and their tax affairs is dealt with in the UK. So I'm not seeing any consequences for the Australian resident individual who's moved to Australia and whose partner hasn't yet joined them.
Thank you. I'll jump to Nick for this one. If you have a pension of greater than 360,000, do you have to leave the remaining in a SIP in the UK, or can you transfer it all to Australia and pay the tax? What would be the tax implications?
So it depends on what the value of your fund is. We've got to factor in the applicable fund earnings. So if it was 360 dead, then and you've lived in Australia a period of time, there would likely be some growth. So you should be able to get that across if there is growth within that 360. If your fund exceeds the 360, then there are options to over contribute. We would need to really look at the pros and cons of that. There can be quite tax consequences of the over contribution, depending on how much it is, how long the fund is left in there, because there is a deemed earnings rate that the ATO apply to the amount that's been over contributed. It's too technical to get into it in here, but in short, yes, there is an option to over contribute, but it can lead to significant taxation on the amount that's over contributed.
Yep. Thanks, Nick. For Alan, I guess, what is required to establish tax residency after moving permanently from the UK to Australia?
Well, it's a self-assessment, ultimately. If you've moved to Australia, you would self-assess yourself as having commenced residency in Australia. And to the extent that you have an obligation to fill in a tax return each year, and most people do in Australia, unlike in the UK, the assertion of residency is dealt with through the submission of the personal tax return. Indeed, in the year of arrival, you are what's called a part-year resident, and on the tax return, you identify the number of months, including part months, for which you've been a resident. So you advise the ATO, the Australian Taxation Office, through the submission of your tax return. In moving to Australia, it's generally best to apply for a tax file number, as it's called, early. A tax file number is Australia's equivalent roughly to the national insurance number in the UK. You apply for your tax file number, and then you'll reasonably plan to submit a tax return after the end of the year and assert your residency status on that tax return.
Thanks, Alan. And I'll keep it with yourself. Are you able to quickly explain further any of the rules around CGT on only owned property if the property is in the UK and you're living in Australia as an Australian tax resident?
Okay. The UK CGT position is that on a disposal, there's a need initially to review the capital gains tax position, to compute the gain, and to pay any tax to HMRC within 60 days of the sale completing. and there's a special property CGT return you submit to meet your compliance obligations in that regard. In Australia, there are different rules for calculating the capital gain in Australia. We start on the basis of what was the value of the property on the day that you commenced residency. And then we calculate the gain with reference to that reference point, that cost base, as it's called. And then we exclude from the charge to capital gains tax period exempt ownership periods. Now, if the property in the UK that's being sold used to be your main residence, you're allowed to treat the property under Australian rules as being CGT free for up to 6 years. If it's being let out, it can be treated as CGT free indefinitely if you're not deriving a taxable income from that property. And so the Australian rules will seek to apportion the capital gain, and you've got a longer period of tax exemption in Australia. Now, that 6-year period is on the basis that you don't own another property in Australia that you want to treat as your CGT-free main residence. So if you move to Australia and renting a property when you first arrive, you can treat a former main residence as being CGT-free under Australian rules for up to 6 years. That's broadly it. The disposal gets reported on your Australian tax return in the year of the disposal, unlike in the UK where you have a separate return to lodge.
Perfect. And similar theme around property there. If we were to sell our UK primary residence after we migrate, will UK downsizing relief apply, i.e. will we still get the residence nil rate band? Okay,
so this is an inheritance tax question. Now, there is a cut-off period. I may need to take this one on notice, but broadly speaking, downsizing relief allows one to, instead of bequeathing the ownership interest in the property, if the property is sold and the proceeds of the sale are bequeathed to a linear descendant, those proceeds of sale can be exempted from UK inheritance tax. Now, there is a cut-off date, which I can't immediately recall when these downsizing provisions came in. But in short, if you're within scope, if the cash from the proceeds of sale are in the UK, it should be possible to bequeath to a linear descendant, but I'd need to look at that one a bit more fully to be more categorical.
No, perfect. Thank you. I'll give you a quick break, Alan. Nick, do you pay tax on super in the accumulation phase if you're over 60 years of age and not working retired?
So anything that's in accumulation, there's capital gains tax on realised gains, can be 15%, but if you've held the asset for 12 months or longer, it's 10%. And there's tax on dividends, distributions, income. If you're 60 and looking to switch that to a pension, which you need to do to come out of accumulation into a pension, then you can draw that pension income tax-free, and you can also move, once it's in pension phase, there's zero tax on capital gains and income and dividends. I think that was the intended question, was it?
I think you've got the crux of that one. Yep. Yeah. I'll jump on this one. Quick question was, can I take my 25% tax-free lump sum from a UK SIPP and choose to invest in my existing Australian super fund? Would there be any advantage of doing that? It's a bit of a two-way answer to that. The answer is yes, but depends. So it is possible to do that, but if you've used your non-concessional caps, then you would be over contributing. As Nick sort of mentioned before, there's implications of doing that. You may be able to use towards your concessional caps by being able to claim a deduction for those contributions. That could be worthwhile. If you are well under that limit, then yes, under the non-concessionals, then yes, there would be advantage of doing that, because you are getting funds into an environment which has tax concessions or tax-free environment post age 65. So there are benefits of doing it. I would say it's one of those questions as well to talk with an advisor, to seek advice on that, to make sure that you have an informed decision informed reason of how to do it, what to do, why to do it, before jumping in and doing that one, because there can be implications of actually doing that. If I go back, Alan, if a non-UK resident with UK assets, which are rental properties, would have the £325,000 IHT band applied for the spouse, if now living in Australia as a permanent resident.
Investment properties are in the UK. Yeah, they're always going to be within the scope of UK inheritance tax, irrespective of your domicile / long-term residency status. So yes, the 325,000 nil rate band would be available in that circumstance too, ×2 if they're jointly owned with a spouse or partner.
Maybe Nick, this one, when does your UK state pension get frozen? When full resident in Australia, or if on a temporary resident visa, e.g. an 870?
It gets frozen once it's in payment. So starting age 67, so if it's already in payment and you're living in Australia, then it gets frozen. And Alan, I think my understanding is as soon as you're in Australia, then it's frozen regardless of your visa status. That's my understanding.
That's my understanding too. It's driven by, I think, your ordinary resident. It's a UK status issue rather than an Australian status issue.
Question: for an individual drawing 2 pensions from previous employment, will they pay tax on this in Australia? They're emigrating across on a permanent residency visa. So if 2 existing pensions being income drawn, will that be taxed in Australia?
Yes, it will. It'll be solely taxable in Australia by virtue of the Article 17 provisions in the treaty. This assumes that the individuals become tax resident in Australia, but assuming that you've moved there on a permanent residency visa to live, then you would self-assess yourself as resident. That pension income would be solely taxable in Australia, and there would be a form filling process to go through to ensure that the pension income is paid on a gross basis. If the forms aren't completed, HMRC, subject to one's other income, but it's often the case that there is some tax withheld in the UK under pay as you earn, and that's not creditable in Australia by virtue of those Article 17 provisions.
All right, thanks, Alan. We'll keep going with a few more because there's still a fair few people online. Conscious that we have gone over time, but there's a lot of questions we do want to try and still get through. Nick, I'm going to give you a bit of a theme around PCLSs and tax-free lump sums. If I have a UK defined contribution pot that I can access now, if I take the 25% tax-free lump sum, is it taxable at my marginal tax rate in Australia? And again, if you want to do the same, if it was a DB scheme as well. So
the 25% is assessable on the growth. The growth element of the 25% is assessable. And that is taxed at your marginal rate. Yes. So you would need to work out what the growth element was from the last taxable event. But if this is the first taxable event, then it would be from your date of arrival. Growth elements taxed at marginal tax rates. For DC schemes, that's for a DC scheme. My understanding is, and I've seen contradictory things from the ATO, but and Alan might jump in on this, but with the defined contribution scheme, the entire amount of growth is assessable regardless of whether you're taking the 25% or not. Whereas for a defined benefit scheme, that growth is apportioned to the 25%. So for a DC scheme, you might get taxed on the 100% of the growth, even though you're only taking a 25% lump sum. But for a defined benefit scheme, then the growth is apportioned to 25%.
Yeah, there's an interpretative decision, isn't there, on that, Nick, issued by the tax office, which lends underpins what you said there. It is possible for individuals to submit private rulings requests of the tax office. In that circumstance, arguably on a what have you got to lose basis, it might be worthwhile submitting a private ruling request to the tax office in an effort to get a proportionate approach rather than the entire AFEs being considered to be included within that 25%. But that's again, you'd look at what's it going to cost to submit a private ruling request and make a value call on whether that's a worthwhile strategy.
Perfect. Thanks, Alan. Probably for Nick, can a SIP-in drawdown be transferred from the UK to Australia? And if so, what is the maximum sum that can be transferred annually and overall? And are there any age limits by when the transfers must be made?
Short answer is yes. Long answer is it depends on what you've done to put it into drawdown. So, for example, if you've taken the full pension commencement lump sum from that UK fund, what you have done is crystallise the entire fund. If that fund is over the $360,000 non-concessional limit after the growth has been accounted for, then you are unable to make partial transfers from a fully crystallised fund. So there are ways around this. So that if you've crystallised and you're over that 360, it's going to be very important to have a chat with us about that. If you haven't fully crystallised, then yes, you can do the 360 every 3 years, plus any growth that's been accumulated to date, and then post every 3-year transfer. And you can make non-concessional contributions up to age 75. So you can do it right up to age 74, as long as you can actually breach 75 as long as it's within 28 days of the month in which you turn 75. So short answer, 75 is the age limit.
Thanks, Nick. There's a couple of questions around retail ROPS funds within Australia. It is a very, very limited space there. There's not a huge amount of options. It is possible, though, that you can contribute your existing Australian super funds into a retail fund there. Again, it would be a suggestion and strongly encouraged to seek advice on that to make sure that the reasons of consolidation are correct and right for you, because there are implications that can come through. Existing retail funds within Australia may have insurance attached, and rolling across may cancel those insurances. So a whole range of things to be aware of first before venturing down that path. Alan, I'll send this one to yourself quickly. Are there any tax implications for gifts of money being sent from family members in the UK and being received in Australia?
So the receipt of gifts from the UK by an Australian resident isn't taxable. It's a receipt of capital, so not taxable in Australia. Gifts made from the UK are going to be potentially exempt transfers, as I mentioned during the presentation. So long as one survives for at least 7 years, those gifts will fall outside the charge to inheritance tax in the UK.
Thanks. We might round out with one last question and then wrap up. I'm a UK citizen with an Australian spouse. We want to retire to Australia in the next couple of years. Are there any tax implications around selling our main residence in the UK and using funds to buy in Oz? And I think the probably main bit of this question is timing of doing that important.
Okay, so property in the UK, selling it while one is residing in the UK, it's a main residence. It's going to be CGT. It's going to be exempt from CGT by virtue of the main residence exemption. If the property is kept for a short period after arriving in Australia, the UK allows one to treat a former main residence as continuing to be free of CGT for up to 9 months. So CGT free in the UK if you sell it within 9 months of leaving. If you keep it longer, we're opening up the potential for there to be a UK CGT liability. So if the intention is to sell it while you're in the UK or within 9 months to avoid any UK CGT implications, and it won't be taxable in Australia, because of that 6-year exemption, which I mentioned earlier. That would be my expectation.
Perfect. Thanks, Alan. There are a fair few questions in there from anonymous attendees. I would encourage for those, if we haven't got to your question, reach out to Alan at BDH Tax if it's more of that tax related side of it, or through to Nick and the rest of our team here at inquiries@bdhsterling.com.au, and we'll certainly be able to answer those. For those where there are names attached, we will look over the coming days to be able to come back and help answer those questions where we can see the individuals that it is. So we will wrap up and close now. So thanks again for everyone who's taken the time out of their day today. We trust the session has been informative and has been useful to you. The session has been recorded, so a copy of this recording will be forwarded to attendees in the next 48 hours, and we'll reach out direct if you did have specific questions. I'd encourage you also please to keep an eye out for the feedback survey as it comes through. Your time will be greatly appreciated there and helps us to form the content that we put into these webinars. That'll come from surveymonkey.co.uk. For those of you who are looking to seek advice from Alan or from the BDH Sterling team, please feel free to reach out to each of our respective email addresses, and we'll certainly get back in contact with you. On behalf of Alan, Nick and myself, thanks again. And on behalf of BDH Sterling, wish you all the best for the rest of your day. Thank you.